Welcome to another episode of Get Rich Slowly, the podcast dedicated to building wealth the right way through patience, discipline, and the power of compounding gains over time. If you're looking for get-rich-quick schemes, you're in the wrong place. Here, we're all about the slow burn, the steady climb, the kind of wealth that lasts because it's built on a solid foundation. Today, we're diving into a fascinating new investment vehicle that's been making waves in the financial world, the Grayscale Digital Large Cap ETF, ticker GDLC. This ETF, recently approved by the SEC in July 2025, offers a unique way to gain exposure to cryptocurrencies without betting the farm on a single coin. But does it align with the get rich slowly philosophy? Let's break it down and see how it fits into a long-term, disciplined approach to wealth building. First, let's talk about what this ETF is. The Grayscale Digital Large Cap ETF is one of the first diversified crypto index ETFs to hit the market. It's not just Bitcoin or Ethereum, it's a basket of the top cryptocurrencies by market cap, with about 80% allocated to Bitcoin and the rest spread across Ethereum, Solana, XRP, and Cardano. Think of it like an S&P 500 index fund, but for crypto. It's designed to give investors exposure to the broader digital asset market without the hassle of managing a crypto wallet or navigating the wild swings of individual coins. For those of us who believe in slow, steady growth, this kind of diversification is immediately appealing. It spreads risk across multiple assets, which is a cornerstone of prudent investing. Now, I know what some of you might be thinking. Crypto? Really? Isn't that the wild west of investing, where people are trying to get rich overnight? And you're not wrong to be skeptical. The crypto market has a reputation for volatility, hype, and yes, plenty of get-rich-quick schemes that crash and burn. But here's where the get-rich-slowly mindset comes in. We're not here to chase the next meme coin or bet on a 10x moonshot. We're here to evaluate whether something like the GDLC ETF can fit into a thoughtful, long-term strategy. And to do that, we need to look at the principles that guide us: diversification, patience, and letting time and compounding do the heavy lifting. Let's start with diversification. One of the biggest mistakes investors make, whether in stocks, real estate, or crypto, is putting all their eggs in one basket. The GDLC ETF tackles this head-on by giving you exposure to 5 major cryptocurrencies. Bitcoin, the granddaddy of crypto, makes up the lion's share, but you also get Ethereum, which powers a lot of the decentralized finance world, and newer players like Solana and XRP, which are carving out niches in scalability and cross-border payments. Cardano rounds it out with its focus on sustainable blockchain tech. By holding a mix of these assets, you're not betting on one coin to rule them all. You're betting on the overall growth of the crypto ecosystem, which is a much safer way to play a speculative asset class. Diversification doesn't eliminate risk. Crypto is still volatile, but it reduces the chance that one bad apple tanks your entire portfolio. Next, let's talk about patience. If you've listened to this podcast before, you know we're obsessed with the idea that wealth isn't built in a day. It's built over years, sometimes decades, through consistent effort and smart choices. The GDLC ETF fits this mindset because it's not about timing the market or catching the next crypto pump. It's about believing that digital assets as a category have a place in the future of finance. Maybe not tomorrow, maybe not next year, but over the next 10 or 20 years. Think about it. 15 years ago, Bitcoin was a niche experiment. Today, it's held by corporations, governments, and institutional investors. Ethereum has spawned an entire ecosystem of applications. The GDLC ETF lets you invest in that long-term potential without trying to pick winners or guess when the next bull run starts. You buy, you hold, and you let the market do its thing over time. That brings us to compounding, the magic ingredient of wealth building. Compounding isn't just about interest, it's about gains building on gains. In the context of the GDLC ETF, compounding comes from the potential appreciation of the underlying assets. Crypto has historically gone through cycles of booms and busts, but over the long haul, the top coins have shown impressive growth. Bitcoin, for example, has delivered annualized returns of over 100% since its inception, though past performance is no guarantee of future results. The key is to stay invested through the volatility. If you'd bought Bitcoin in 2011 and sold at every dip, you'd have nothing. If you'd held, you'd be sitting on life-changing gains. The GDLC ETF encourages that hold mentality by offering a diversified, professionally managed way to stay in the game. You're not day trading, you're planting a seed and letting it grow. Now let's address the elephant in the room. Risk. Crypto is not for the faint of heart. The GDLC ETF, despite its diversification, is still tied to a highly volatile asset class. Prices can swing 20% in a week. Regulatory crackdowns, technological hiccups, or market sentiment can send things spiraling. And let's not forget the expense ratio, 2.5% annually, which is steep compared to a traditional index fund like one tracking the S&P 500 at 0.03%. That fee eats into your returns over time, which is a real concern for us slow and steady types. So how do we reconcile this with the get rich slowly philosophy? It's about position sizing. If you're going to invest in something like GDLC, make it a small part of your portfolio, maybe 1 to 5% if you're younger, or more risk tolerant, less if you're closer to retirement. Treat it like a spice in your financial stew. A little adds flavor, but too much ruins the dish. By keeping your exposure small, you can participate in crypto's upside without risking your entire financial future. Another point to consider is the structure of the ETF itself. Unlike direct crypto ownership, where you're dealing with private keys and exchanges, the GDLC ETF trades on major stock exchanges like any other ETF. You can buy it in your brokerage account, your IRA, your 401k, wherever you're already investing. This accessibility is huge for long-term investors who don't want to mess with the technical side of crypto. Grayscale, the firm behind the ETF, has been in the crypto space for years, managing billions in assets. They're not some fly-by-night operation, which adds a layer of trust for those of us who value stability. That said, do your homework. Read the prospectus, understand the fees, and know that Grayscale's ETFs have historically traded at premiums or discounts to their net asset value, which can affect your returns. Let's zoom out for a moment and think about why crypto, and by extension this ETF, might matter in a get-rich-slowly portfolio. The world is changing. Digital currencies are no longer just a techie curiosity. They're being integrated into payment systems, supply chains, and even central bank policies. The total market cap of crypto is over $2 trillion as of today, October 10th, 2025, and growing. If you believe, as I do, that wealth building is about positioning yourself for long-term trends, then having some exposure to this space makes sense. But, and this is critical, it's not about going all in. It's about allocating a small, thoughtful portion of your portfolio to an asset class that could compound significantly over decades while keeping the bulk of your money in proven, less volatile investments like stocks, bonds, and real estate. So how do you actually use the GDLC ETF in a get-rich-slowly strategy? Here's a practical approach. First, decide if crypto aligns with your risk tolerance and investment goals. If you're not comfortable with 50% drawdowns, this might not be for you. Second, if you decide to invest, set a fixed allocation, say 2% of your portfolio, and stick to it. Don't keep adding more just because the market's hot. Third, use dollar cost averaging. Instead of dumping a lump sum into GDLC, buy a little each month or quarter. This smooths out the volatility and keeps you disciplined. Fourth, rebalance periodically. If crypto moons and GDLC becomes 10% of your portfolio, sell some to bring it back to 2%. If it crashes, consider buying a bit more to maintain your allocation. This is classic get rich slowly. Stay consistent, avoid emotional decisions, and let time work its magic. One thing I love about this ETF is how it democratizes crypto investing. Not everyone has the time or expertise to research individual coins or navigate exchanges. GDLC does the heavy lifting for you, rebalancing its holdings to reflect the top coins by market cap. It's like buying a mutual fund in the 1980s before index funds were mainstream. You're getting in on a new asset class early, but in a structured way. That said, don't be fooled into thinking this is a set-it-and-forget-it investment. You still need to monitor the crypto space, keep an eye on regulatory changes, and be prepared for bumps along the way. The get-rich-slowly path isn't about avoiding all risk. It's about taking calculated risks and managing them wisely. Before we wrap up, let's talk about the bigger picture. The GDLC ETF is exciting because it represents a maturing of the crypto market. When Grayscale's Bitcoin Trust converted to an ETF a couple of years ago, it was a game changer. Now, with diversified ETFs like GDLC, we're seeing crypto move closer to mainstream acceptance, but mainstream doesn't mean risk-free. The get-rich-slowly philosophy reminds us that no single investment is a silver bullet. Wealth comes from a diversified portfolio, consistent contributions, and the discipline to stick with it through market cycles. If you're intrigued by GDLC, treat it as one piece of a much larger puzzle. Keep maxing out your retirement accounts, keep investing in low-cost index funds, and maybe, just maybe, carve out a small slice for something like this ETF to add a bit of growth potential. As we close out today's episode, I want to leave you with a reminder. Getting rich slowly isn't flashy, but it works. The GDLC ETF might be a shiny new toy in the investment world, but it's not a lottery ticket. It's a tool, one that could play a role in your portfolio if you use it thoughtfully. Do your research, know your risk tolerance, and always think long term. That's how you build wealth that lasts. Thanks for tuning in to Get Rich Slowly. If you found this episode helpful, share it with a friend who's curious about crypto but doesn't want to dive in head first. And as always, keep investing, keep learning, and keep growing, slowly but surely. I will see you next time.